Now, without the financial accounting book, believe me, I'm not pushing our book, but our book is pretty good. If you don't have it, I would buy it. It makes things easier. In fact, if I ever do these things in the future, which I think we will, everyone's going to have to buy the book because it would be a lot easier. I'd go a lot faster. So what is today's topic? By request, statement of cash flow. And I want you to turn, if you would, Carrie, can you bring up page 1B as in boy 20? 1B as in boy 20? Okay. Carrie, are you still with me? I don't hear Carrie. She's got a mute on. Okay. All right.
Sorry, Phil, I'm pulling up the page right now. Give me just a second.
I'm sorry.
No worries.
If your husband's bothering you, we have to get him a hobby.
Nope, that is not what it is.
All right, let's put him up on the slopes. By the way, her husband is a ski instructor at Breckenridge, Colorado.
Okay, you should see it now.
All right. I'm sorry. I didn't mean to. I hope I'm not embarrassing your husband. So.
No, not at all.
All right. Anyway, just some beginning information. The statement of cash flow. It's going to show basically, all right, there's 3 sections of it. And the purpose of the 3 sections is to see where your inflows and outflows of cash are going. However, like anything else in accounting, there are always disclosures, all right? And what we have here is, these are disclosures that are required according to ASC topic 230. And what we're doing, here's the disclosures. Conversion of debt to equity. If you convert from bonds to stock, you have to disclose it. Conversion of preferred stock to common stock. Acquisition of assets through capital leases. When you buy an asset through a capital lease, what you do is you debit an asset that you're buying and you credit a lease liability. Now, notice there's no inflow or outflow of cash. And then we have acquisition of long-term assets by issuing notes. These are considered non-cash investing and financing activities, all right? And let's continue on here. Now, if Carrie would just move down a little, all right? The thing you have to remember is there's 3 sections of the statement of cash flow, all right? The operating activity section, the investing and financing. Now, only with the operating activities do we have 2 methods of showing it, all right? We have the indirect method. In the indirect method, what you're going to see is we're going to start with the net income, which is on an accrual basis, and we're going to convert that net income to cash basis, which will give us cash received from customers, all right? And there's also the direct method, and I'm going to show you both methods, all right? The page I'm on is 1B20, 1B20, all right? Now, remember, the operating activities will show our day-to-day operating income and expenses. Now, investing activities are this. Remember, this is a cash flow statement. So if we buy assets for cash or we sell assets for cash, and notice that's be non-current assets, all right? It goes to investing inflows and outflows. And of course, financing activities are the methods we use to raise money. All right. For example, if we issue common stock or preferred stock for cash, if we go and borrow money, all right, whether it's a short-term obligation or long-term, all right, that's cash coming in. When we pay the principal on that note, all right, that's considered an investing outflow. I'm sorry, I said that wrong. All right. When we borrow money, all right, that goes into financing inflow. It would be a payable, right? But it's got to be for cash. We're getting money. Also, all right, when we pay off the principal on loans, that is a financing outflow. So to recap, operating day-to-day activities, investing, acquisition, disposal of assets for cash, financing are the methods we use to finance the company. Now, remember, there are 2 formats available. All right, but the only difference between the 2 formats, the direct method and the indirect method, if you would raise this thing up, Carrie. Carrie, to the top.
Yep, it's coming.
Okay, thank you. All right, now we have the operating activities, investing, financing. Notice they're the same under both methods, the direct or indirect, all right? Investing and financing are the same, but the operating is the section that's different, all right? Now, the one that I've heard is on the exam more than others. And of course, I don't see the exam, but I just have to go with students say, the indirect method. That's where you're starting with the net income and converting from accrual net income to cash net income. All right. Now, it says here on the bottom, here's a statement. Nearly all corporations prepare the statement of cash flows using the indirect method. The indirect method. All right. Now, Carrie, we're going to do this. All right. All right. I want to go to page 1B22. All right. 1B22.
There we go.
All right. Now, on the bottom, I want you to go down on the bottom, please. Keep moving down. It'll say the fake cash approach.
Yep.
All right. Now, what you're going to do with the indirect method is you're going to start with the net income from your income statement on the accrual basis. And you're going to convert that net income to a cash basis. Now, what you're going to do is to convert the net income from accrual to cash, you have to make certain adjustments. For example, you're going to have to add back non-cash expenses, all right? Because we only want net income on a cash basis, all right? And net income has depreciation expense taken out, all right? That has nothing to do with cash, so we got to add it back. So we're going to add back non-cash expenses, and then we're going to subtract out non-cash income. Now, here's examples of non-cash expenses to be added back. Depreciation expense, amortization, bad debt, amortization of bond discount, and losses. Losses are always considered non-cash expenses. Now, please note, why do you add back amortization of bond discount? Because when you amortize bond discount, your journal entry is you're crediting bond discount and debiting interest expense. So that's non-cash interest expense. You got to add it back. Now, here is examples of non-cash income you're going to subtract from the net income. Gains, equity and earnings. Under the equity method, if you own 20% or more, you can exercise significant influence. You have to make an entry to pick up your share of the investee's net income. The investor has to do that. So they debit investment and credit equity and earnings. That's a non-cash earnings, all right? Amortization of bond premium. Well, when you amortize bond premium, you debit bond premium, credit interest expense. Well, crediting interest expense is like crediting interest income. So therefore, all right, that has to be subtracted out from the net income. All right, now, we're going to talk about the fake cash method in a few seconds. All right, but, all right, let's go to page 1B23. And I want to show, it says the fake cash approach. Don't worry about that right now. All right. Why are gains non-cash? I'll tell you what, if you wait, all right, I ask that question again when I get to the investing activities, okay? Would you please do that? And I'll show it to you. All right, now, thank you. All right, now the next thing. On page 1B23, I want to go down to letter B if I can. All right, and we have the direct method. Now, direct method, the indirect method says we're starting off with the income statement indirectly. Indirectly is going down to net income. And we know that sales minus all costs equal net income. Now, with the direct method, we're going to every item on the income statement and converting it from accrual to cash. Now, you have to know, all right, what balance sheet account will convert the sales from accrual to cash. Because here's the captions. On the direct method, we have cash collected from customers, interest received, dividends received, cash paid to employees, cash paid to suppliers, interest paid, and income taxes paid. Now, this is just something you have to remember, all right? When you take your sales, it's on an accrual basis, all right? I'm going to show you by the use of the fake cash method that by looking at the balance sheet account, accounts receivable, you'll know whether to add or subtract accounts receivable from the sales to get cash sales. And you have to know the reciprocal account that you're going to use to start with, which is the interest revenue. Now, what balance sheet account we use to convert that to cash basis? Interest receivable. All right. Dividends received, you're going to start with dividend revenue. All right. And I'm just going over this right now. Don't panic. all right? It'll all make sense, all right? And the account on the balance sheet to convert the dividend revenue to cash basis is the change in dividend receivable. And then cash paid to employees, all right? Notice these are all on the income statement. Salaries and wage expense. What account are you going to use to convert that to a cash salaries paid? All right, the salaries and wages payable. Now, cash paid to suppliers, all right? The item on the income statement is the cost of goods sold. You're going to use the inventory and the accounts payable account to convert the cost of goods sold to cash paid to suppliers, all right? The interest paid. What's the income? What's the expense? Sorry, you just gave me. What's the item on the income statement for interest paid? Interest expense. Now, what balance sheet accounts will you use to convert the interest expense to interest paid? Excuse me. You'll use the interest payable, the discount on bonds payable, or the premium on bonds payable. All right. And then income taxes paid. You'll start with income tax expense, and you'll look at income taxes payable, deferred income tax assets, deferred tax liabilities, and don't worry about other operating paid. All right. Now, this is all going to come together for you. All right. And we're going to go to page 1B4. All right. Now, 1B4, this is where we're going to have to use, we're going to go back and forth. If they give it to you as a task-based simulation, the whole idea of task-based simulations is you have to know what documents you need, all right, to come up to a certain item, all right? In other words, they're going to throw documents at you. Well, if you're using the indirect method or the direct method, you have to use your income statement, all right? And then, all right, to convert the net income from accrual to cash, you're going to look at changes in the balance sheet, current assets, current liabilities that disappeared.
Sorry, Phil. I think that you meant you wanted to look at the 1B24, and
Yes,
that's what we have in the separate.
1B25, yes.
Okay, that's what I'm going to pull up in the separate
Okay.
document. Just a moment.
All right, now give me some time and I will bring this all together for you. All right. All right, now they give you documents on the exam. All right, the first document here is, all right, the balance sheet. Now, you'll notice they give you the different assets: cash, accounts receivable, inventory, land, property, plant, and equipment, accumulated depreciation, accounts payable, interest payable, mortgage payable, common stock, retained earnings. Now, what you want to do is this. You're going to take the changes in the accounts from 20x1 to 20x2, all right? Like cash, it went up by $12. So the statement of cash flow, when you actually compute it and show the different sections, operating, investing, and financing, all right? They should show net inflows and outflows with an increase in cash. So what actually contributes to that increase in cash? All right. It's the operating activity section, investing and financing. All right. Now, let's go to the income statement. All right. And, all right, let's show you, here's the income statement. Let's show you how we do the indirect method. All right. Indirect method. Now, what I'd like you to do is this. All right. I'd like you to take a piece of paper. Actually, you don't need a piece of paper. Well, all right, take a piece of paper if you would. All right. And I want you to put 3 sections. Turn to page 1B28, Karen. Can we get the 1B20? Okay.
This is the indirect method?
Yes.
Okay.
All right. Now, we're going to start off with net income. There's no way of having these next to each other, is there?
No.
All right.
But we can
Let's
jump
go
back.
back. I'm going to flip between the income statement and the statement of cash flow here, the indirect method, okay? All right, let's go to the income. All right, let's start here, all right? Your starting point in the operating activities, the indirect method, is to start off with your net income, all right? Now, that's $88. So if we go back to the income statement, you will see, all right, that the net income, where it says item number 1, is $88, all right? Now, we have to convert that from accrual to cash. Now, what do we use to convert that from accrual to cash? All right, we make adjustments. The adjustments are created by changes in current assets, current liabilities, changes in unamortized discount, unamortized premium, and changes in deferred tax assets, deferred tax liabilities. All right, now let's look at the balance sheet a second. All right, now the first thing, accounts receivable. Let me show you how you do this. Accounts receivable, go down each current account. Accounts receivable went what? From 186 to 212. So it went up by $26. Now, using my fake cash method, the question is this: do you add that change to net income or subtract it? Well, net income is considered an inflow, and we said that was $88. Now, accounts receivable has gone up. All right, now this is a fake cash entry. The entry does not exist. All right, so what you do is this. All right, you credit, accounts receivable went up. Debit accounts receivable, this is my fake entry. All right, notice accounts receivable went up. Debit accounts receivable, credit fake cash. When you credit fake cash, all right, you're reducing cash, and that's considered an outflow. So an increase in the accounts receivable, all right, the debit of $26 and the credit of cash, the $26 is an outflow of cash from the accounts receivable. Well, net income is a what? Inflow, all right? The $26 is an outflow. So if we go to the statement of cash flow indirect method, you will see, all right, let's go to that, please. All right, you'll see that all right, if you see the increase in accounts receivable, notice it's $26 reduction of net income, okay? All right, now let's go back to the balance sheet. Let's go back to the balance sheet. All right, that's the first thing. And by the way, check these off. You did accounts receivable, check it off if I had the thing in front of me. Now let's look at inventory, our current account. Inventory went up by $22. All right, let's make a fake entry. Debit inventory, credit fake cash, $22. All right, credit to fake cash with the inventory would be a what? Outflow. Net income is an inflow. We're going to subtract the $22 as an adjustment to net income. Let's go to the statement of cash flow. All right, see the 22? We subtract it from the net income. We consider that adjustment an outflow. All right, now let's see what other accounts we have in the balance sheet, the current accounts. Okay, let's go back to the balance sheet. And the next account is inventory. Now, inventory went up. Did we do that one? I don't think we
just did that one. Yep.
We did that one? Okay. So we did the accounts receivable inventory, the two current accounts. Now, land, property, plant, and equipment, accumulated depreciation. All right. We're not going to use that right now. All right. But let's go down to the current liabilities. All right. Number 8. See number 8? That's the notes. All right. Accounts payable. Let's make an entry here. Accounts payable went up by $10. So we're going to credit accounts payable, debit fake cash, $10. All right. A debit to fake cash is an inflow. Net income is an inflow. We're going to add $10 to the net income. All right. We go back and look at this. And what do we notice about the $10? All right. Where is that? Accounts payable. All right. Accounts payable, increased accounts payable is an addition to net income. All right. Now let's go back to the balance sheet. And the next current account is interest payable. Now the interest payable went down by $4. Let's make a fake cash entry. Debit interest payable, $4. Credit fake cash, $4. All right. So credit to fake cash is an outflow. We're going to subtract that $4 from the net income as an adjustment. Let's go back to that. All right. There is the decrease of $4. Okay. All right. Now, if we go back, all right, there are, all right, let's go back, please. All right, you'll notice the mortgage payable is not a current liability. All right, although you could argue that the current portion is current, but assume the mortgage payable is non-current. So we've actually accounted for the current accounts, the accounts receivable, inventory, payable, etc. Now let's do the non-cash expenses. All right, well, the non-cash expense, all right, let's go to the income statement a second. And the income statement, and notice the depreciation expense is given. They give it to you, all right? Now, if they don't give it to you, there's another way of getting it. But if we go down the income statement here, we'll see that depreciation expense, all right, is a non-cash expense. We have to add that back to net income. All right, 108. You pick that, you want to see it? All right, good. All right, now we go back to the income statement. Let's see if there's any other items. All right, let's go to the income statement. Are there any other non-cash? We're just going to scrutinize this. Depreciation, interest, no. Income taxes, total expenses, net income. Dividends on common stock. Dividends on common stock, by the way, are, all right, when you pay cash dividends, it's a financing activity. Dividend income is what? Operating, all right? But that's the end. So we go back to the statement of cash flow. And we find out, well, we take the 88, we add the 108, add the 10, subtract 26, 22, and subtract the 4. So we call that net cash providing by operating activities, okay? All right, now, it says here, the next thing, all right? We had the sale of equipment, all right? The sale of equipment. Now, where did they show us the sale of equipment, all right? Now, if we go to page 1B, let me just make sure this, all right? If we go to, one second, all right, I just want to make sure where that entry is. Okay, here we go. All right, go to page 1B25. All right, now, they would tell you this, all right, or give it to you in a memo. They would say, during 20X2, Wilco sold equipment with a historical cost of 30, with accumulated depreciation of 20 for $10 cash. All right, now, here's the entry. All right, credit equipment, all right, debit accumulated depreciation, debit cash $10. So therefore, all right, notice we have a debit to cash of $10, all right, and where does this go? The sale of an asset goes into what? Investing activities. So what we would do is we would take this $10, they have to give you this, and you would take this over the statement of cash flow, and you would tell you that, all right, sale of equipment, $10, all right? Now, there's also a purchase of the equipment, all right? Now, let's go back to that. Let's go back to that. All right, now, this is what we do, all right? In order to find out how much equipment was purchased, we do the following. Set up a T account, and, all right, the beginning balance is $1,580. Where do we get that from? The balance sheet, all right? Go to the balance sheet. Because what do they give you? They give you, all right, the beginning balance, the ending balance, all right? Now, what's the beginning balance of property, plant, and equipment? It is $1,580, all right? Go back to the T account. We were just on, all right, $1,580. Now, notice, all right, we sold equipment from the entry right above that for 30. That's a credit. That gives you a subtotal of $1,550. All right, now, they gave us the beginning, the sale, all right, and now we have to back into the purchase. We have a subtotal of $1,550. If you go to the balance sheet and you look at property, plant, and equipment, the ending balance of property, plant, and equipment is $1,660. All right, go back to the T account. And we know the ending balance is $1,660. We had a subtotal of $1,550. So we have a purchase of $110. All right, so the purchase of property, plant, and equipment, all right, for cash is $110. All right, we go to the investing activities. all right? And this would be a what? An outflow of 110. Let's go back to the statement of cash flow. All right, and we have there, purchase of equipment, 110, all right? That's all we have for investing activities. So notice, all right, we have net cash provided from operating activities of 154. We have investing activities of 100 outflow. All right, now let's look at our financing activities, all right? Financing activities, all right? Now, with the financing activities, all right, what do they give us? Well, obviously they have to tell us something here. Hold on one second. All right, let's look at, they have to tell you they retired something. Bear with me a second. Okay, all right, let's go to the balance sheet a second. Balance sheet. All right, now, the other account we have is mortgage payable. All right, now, let's go, you check off every account. All right, we have it in yellow here. We've accounted for the accounts receivable, the inventory, all right, property, plant, and equipment, all right, and accumulated depreciation. We got the 88. Can you yell at that one, Carrie? The accumulated depreciation. And, all right, we account for accounts payable, interest payable, mortgage payable. Now, let's look at common stock. Common stock, 20x1 was 500. 20x2 was 500. They didn't issue any stock, okay? All right, so we can yellow that off. All right, and, all right, let's see what we have here. Now, let's look at our retained earnings account, okay? I would like you to set up a T account, all right? And the T account is going to be for, all right, retained earnings. All right, now let's get the opening balance here for retained earnings. Bear with me. Set up a T account, okay? All right, now our T account is, if you put retained earnings, a T account, the opening balance at 20x1 is 280. Now, we know our net income, all right, that we got was how much? What was our net income? That increased retained earnings. All right, go to the income statement, Carrie. All right, our net income was 88. So we increased the retained earnings by $88, all right? So here's our T account. You set up a T account, all right? You have an opening balance of 280 at 20x1. You add a net income of 88. Subtotal is 368. Now, what's the ending balance of retained earnings? It is $348. So how did we go from 368, which is the 280 plus the net income, to 348? The only thing you can assume is what? They actually declared a dividend, all right? So what we'll do is we'll debit retained earnings, all right, for $20. Now, see if there's a dividend payable account on the balance sheet. Because if there's a dividends payable account on the balance sheet, then some of those dividends are owed, and the difference would be the dividends paid. Well, there are no dividends payable here. So therefore, we're going to assume that all of the $20 dividends, all right, was paid in cash. All right, dividends paid is a financing activity. We should have an outflow of 20. Let's go to the indirect method. All right, dividends paid 20, outflow. All right, now let's go to, all right, we got that. Now let's look at our last account. By the way, I'm checking off these accounts on the changes on the balance sheet as I go through it. All right, now let's go back to the balance sheet, please. All right, now we haven't accounted for the mortgage payable. Carrie, you have that yellow. Did we account for that?
I believe so.
We did? Okay. Mortgage payable went down by
Oh,
what?
no, I apologize. We hadn't.
All right. Mortgage payable, if you go back to that, all right, went down from 240 to 218. Don't apply the fake cash method to it. Only the current accounts and the other accounts I told you. So mortgage payable went down by 22. That means that they must have what? Paid down $22 of the mortgage in cash. All right. So that would be what? When you pay off the debt, that's an outflow under financing. Let's go back to the indirect method. all right? And notice, all right, we retired mortgage payable of 22, all right? So let's yellow that. So therefore, our subtotal net cash used from financing activities is 42, all right? Now, if we add up all of the activities, we have net cash inflow of 154, a net cash outflow from investing, and net cash outflow from financing, all right? That will give us what? A change in cash of $12. Now, if we go to the balance sheet, all right, we go to the balance sheet, you'll see the cash went up by what? $12. So therefore, if we go back to the statement of cash flow, we have the net increase in cash, cash equivalents, and restricted cash. All right. Now, I'll explain to you what that means in a second. Now, to that, we're going to add the beginning cash balance, cash equivalents, restricted cash of 104. That's the opening cash balance. You can go back and look. It's there. And then, all right, the ending balance of the cash at 20x2 is 116. All right. Does it show 116? Yes or no?
Yes.
Yes. All right. We go back to the indirect method. All right. There is your statement of cash flow. Now, this is one thing to know. If the indirect method is used, the company has to disclose the following: interest paid, all right, taxes paid. Also, a disclosure must be shown for non-cash investing and financing activities. I showed you that. If you buy a building, all right, and you finance it, it's a debit to building, credit to mortgage payable. All right, now that's considered non-cash investing, the building, all right, and financing would be the mortgage payable. You have to show those disclosures of non-cash investing and financing activities. Now, people say to me, Phil, why do you have to show a disclosure of interest paid? Well, if you look at the indirect method, all right, there is no separate item for interest paid, all right? There isn't. Now, that's very important because you're going to take this statement of cash flow to a bank, and the first thing, they're going to look at two things actually, all right? Do you have any other loans, and did you pay the interest? Well, it doesn't look like, it doesn't show interest paid here, does it? No, it doesn't. All right, so you would have to show a disclosure. Interest paid, all right, is equal to so-and-so. Now they're saying you're paying your interest on other loans. Now, what about the taxes paid? All right, taxes paid is not a separate item on the indirect method. All right, so what you're going to do is you're going to disclose it. Taxes paid so-and-so. Now, why do they want to see taxes paid? They want to see it because, all right, if you're not paying your taxes to the government, all right, what happens is the bank's not going to lend you money based on your statement of cash flow, because if they lend you money and you're not paying your taxes, what's going to happen? All right, they're going to go against all the money you have, which includes the money which is lent by the bank. So even though the bank lent you money, all right, maybe it's secured. Remember, the IRS always has first right to the money for the taxes paid. All right. So if you're not paying your taxes, they don't want to lend you more money. All right. Do you understand that? You may be in default for the what? The IRS. They don't like that. They don't like that. All right. So here is the indirect method. Now, I would do this. If you have the book, I would try this myself. Now, a few other points here. Notice the $12 is a change in cash, cash equivalents, and restricted cash. You are now required to show change in cash. A cash equivalent is defined as, all right, a highly liquid investment that can be readily converted to known amount of cash and has an original maturity of 3 months or less. So if you buy a treasury bill, all right, a money market account, if its maturity is 3 months or less, all right, that's considered a cash equivalent. So let's assume I make this entry on the books. Debit, all right, marketable securities, credit, cash. All right, where do you show that on the statement of cash flow? And the answer is you don't, because marketable securities is a what? All right, equivalent to cash. It's a cash equivalent. All right, as long as its original maturity is 3 months or less. So therefore, If a marketable security is equivalent to cash, you're debiting cash for the marketable security and you're crediting cash. You don't show a debit credit to cash, it's a wash. Now, what is restricted cash? All right. Now, I want you to go to page 1B21. Okay, now 1B21 says there have been 2 recent accounting standard updates. ASC Topic 230, Statement of Cash Flows. The first one is, you don't have to memorize the numbers. ASU 2016-18, restricted cash. Both updates are eligible for testing. Well, we're beyond first quarter of 2018. The restricted cash category, all right, is now included on the statement of cash flow for profit-making entities. Entities must either present restricted cash, all right? What about post checks? Is that post-dated checks? Oh, I'm not, all right, hold that question a second. Let me read this. Okay. Entities must either present restricted cash as reported in the balance sheet on the face of the statement of cash flow or disclose the amount in the notes of the financial statements. For example, the following is appropriate on the face of the statement of cash flow: net increase in cash, cash equivalents, and restricted cash. Cash equivalents and restricted cash at the beginning of the year, cash equivalents are restricted at the end of the year. All right. All right, we have a few questions. What are they, Karen?
Oh, no, I think that there was just the questions that came in that you were going to come back to.
All right. Yeah, I'll take the question right now.
So the post check due less than 3 months?
A post check? What's a post check? I don't know what a post check is. If I buy a marketable security, all right, and its maturity is 4 months, it's not a cash equivalent. So therefore, if I buy a marketable security that has an original maturity of 4 months, that's shown in the investing activities. It's an acquisition of an investment. Now, what happens if I buy a marketable security or a treasury bill, which has an original maturity of 4 months, but it's going to mature in 1 month? Do you show in the statement of cash flow? And the answer is yes, because you don't look at the maturity left or the period left to cash it in. You look at the original maturity. And if that cash equivalent, marketable securities, treasury bills, has an original maturity of 3 months or more, you must actually show it as a what? Cash equivalent, which means that, I'm sorry, I say cash 3 months, 3 months or less. Let me repeat that. If you have a marketable security, a treasury bill, whatever, and the original maturity is 3 months or less, all right, that's equivalent to cash. You don't show it on statement of cash flow. But, all right, if you have a marketable security that is 4 months, all right, but it's going to mature in 1 month, all right, do you show it on the statement of cash flow? And the answer is what? All right, if the original maturity is more than 3 months, yes, you show it, but as an investing activity. All right. Any questions?
I think the follow-up question to the post-dated check is that, for example, a client gives you a $2,000 check that clears in 1 month. So that would be within the 3 month window that you were just talking about. So that would be a cash equivalent.
The month that it clears. That's
right.
when it's coming. That's when it shows in cash.
Right.
First of all, I'm going to tell you very honestly, you're never going to see on the exam a post-dated check. Okay. All right. These are publicly held companies. You understand that? That usually they're testing on. All right. So then if someone comes in and gives you a post-dated check and says, give me the goods, will you give it to them? Only if you're stupid. All right. All right. Never accept post-dated checks. I just wouldn't. All right. And they won't give you on the statement of cash flow a post-dated check. All right. So right here is the appropriate categories, the net increase on cash, cash equivalents, and restricted cash. All right. Now, what's restricted cash? Restricted cash is cash which is set aside for a future event. Okay. All right. Now, if you look at, let me see here. All right. If you go down a little ways, the page, example, reconciliation. Okay. Definition, here we go. The definition, you see that? The definition of restricted cash or restricted cash equivalents does not change. Amounts included in restricted cash includes amounts designated by contractual agreement with an insurer for the payment of specific workman's compensation claims. All right. So if they give you cash, all right, and there's a contractual agreement that you use that money, all right, just for workman's comp, that's considered restrictive cash. All right. Now, when claims are paid, we debit workman's compensation, credit restricted cash. Restricted cash includes in other long-term debt assets on the statement of financial position. It represents amounts pledged as collateral for long-term financing arrangements as contractually required by the lender. The restriction will end when the related long-term debt is paid off. Okay? All right. So that gives you an idea what restricted cash is. Okay? All right. Now, let's do the direct method of the statement of cash flow. Now, the direct method, let me go back here a second. The direct method is on page, what page is that on? I show it here. All right. We're using the same facts as we did. Okay. It's on page 1B26. All right. 1B26. All right. Now, here is the direct method. The direct method says, I meant, do you have, oh, I'm sorry, Martha, I meant, do you have to disclose it? Disclose what? I'm sorry. I don't remember what the beginning was.
Disclose restricted cash on the SCF.
Do you disclose it? I don't believe you do. Let me see here. You show it as, that's a good question. Can you just hold that? And I'll just, all right. I will get you an answer after we break for about 5 minutes, okay? I would think that, it says here in the book, but I have to go look it up, okay? All right, I want to go, all right, Martha, just hold on. I won't forget you. All right, go to page 1B26, statement of cash flow, the direct method, all right? Now, notice here, you got to put the caption, who, what, and when. Who is the Wilco company? What is the statement of cash flow? And remember, it's for the year ended, all right? It's not at December 31st. The only statement that says at December 31st is a balance sheet, statement of financial position. But an income statement, statement of cash flow says for the year ended December 31st, X2. Now let me go through this with you, all right? And you can flip back and forth a lot easier, all right? You have to know how you get each of these captions: cash collected from customers, cash paid to employees, cash paid to suppliers, cash paid for interest, cash paid for income taxes, all right? And then the investing activities and the financing will be the same as you did under the indirect method. All right, now, you got to know these captions. Cash collected from customers. You always start with the income statement account. That would be your sales. All right, now what, all right, can you go, we can just, oh, okay. All right, let's go back to that. I'm staying with, I'm not gonna flip back and forth, okay? Let me just stay with that direct method, okay? All right, so you have sales. We know sales is an inflow of cash. Now, if you look at the balance sheet, we're not gonna look at it, but there was an increase in accounts receivable. Now let's look at the fake cash method. If accounts receivable goes up, we debit accounts receivable, credit fake cash. Credit to cash is an outflow, all right? Sales is an inflow. We subtract the $26, and now we have cash collected from customers. This could also be multiple choice, by the way, all right? Now, the next cash paid to suppliers, all right? No, I'm sorry. Cash paid to employees. You go to the income statement, you take the salaries and wage expense, that's an outflow, and you look to see if there's a salaries or wages payable. Now, there was no change. There was no salaries and wages payable. I don't think there was one. I'm just gonna look, let's just very quickly. All right, there was no salaries payable on the balance sheet. All right, so therefore, the cash paid to employees was the salaries and wages. It was all cash 560 outflow. Now, cash paid to suppliers, all right? You know your starting point is an income statement account, cost of goods sold, all right? Now, think about it. What two balance sheet accounts are you going to use to convert cost of goods sold to cash paid to suppliers? You're going to show your accounts payable and your inventory account. Just remember that, all right? Now, inventory, when you go back to the balance sheet, inventory increased by $10, okay? All right, here's the entry. Debit inventory, $10. Credit fake cash, $10, all right? Credit to cash is an outflow, all right? What you're going to do, I don't know what happened to this thing here. It should be, I think this thing is not lined up correctly, isn't it, Carrie?
I'm showing increase in inventory is over here in the minus
Right.
22.
Oh,
And then
okay.
increase in AP is the 10.
Oh, okay. So that would be a debit to cash, credit to accounts payable. That's an inflow. All right. So this is where they're getting it. This is not exactly lined up. All right. The increase in inventory is an outflow. Why? Debit inventory, credit fake cash. So that 22 has got to be moved over under the 1576. So your starting point is cost of goods sold, outflow, 1576. We have a $22 outflow. Okay. All right, that's good. And then we have a $10 inflow from the change in accounts payable. So therefore we have a total outflow, cash paid to suppliers, 1588. So you have to know, all right, we'll continue on here. I'm not done. All right, but cash collected from customers, what's your starting point? What? Sales, income statement. All right, what's the balance sheet account you can use to convert that from accrual to cash? Accounts receivable. Apply the fake cash method. Remembering that sales is an inflow. All right, so if accounts receivable goes up, you debit accounts receivable, credit cash, that's an outflow. Subtract that outflow from the sales, okay? Now, cash paid to employees, all right? You start off with wage expense, salary expense, which is an outflow. And the account you're going to use, which you're going to apply the fake cash method, is to salaries or wages payable. Now, cash paid to suppliers. This could be a multiple choice, all right? Cash paid to suppliers. Your starting point on the income statement is what? Cost of goods sold. It's an outflow. What two balance sheet accounts you use to convert that to cash paid to suppliers? You apply the fake cash method to accounts payable and inventory. See that? Now, cash paid for interest. All right. Your starting point is interest expense. All right. Now, what's the balance sheet account? By the way, that's an outflow. All right. Is there any increase or decrease to interest payable? They say, is it decreased interest payable? Make a fake cash entry. Debit interest payable, credit cash. That's an outflow. All right. Interest expense is an outflow. So the total cash outflow for interest is 28. All right. And then we have cash paid for income taxes. All right. Now, here's your items. You're going to take the income tax expense, an outflow. All right. Now, what's in income tax expense? All right. Well, there's the actual taxes you pay to the government, and also the changes in deferred assets and deferred liabilities. Think about it. All right. When you set up a deferred tax asset, do you remember this? You debit deferred tax asset and you credit income tax expense deferred. All right. Now, remember, income tax expense consists of two things. Your income tax expense current, that's what you actually pay the taxes with, but also income tax expense deferred. Those two equal your total income tax expense. So you have to take out from the income tax expense, all right, first of all right, look to see if the income tax is payable, all right, if that was an inflow or outflow, but also the changes in the deferred income tax asset and the deferred income tax liability. Apply the fake cash method to that, and then you'll come up with your cash paid for income taxes. All right, now you add all these things. All right, You have your cash collected, 2374. You have a cash paid to employees, 560 outflow. We have cash paid to suppliers, outflow, 1588. We have cash paid for interest, 28 outflow. And then we have, all right, cash paid for income taxes, 44 outflow, all right. And it says here, provided from operating activities. Is that the right terminology, Carrie?
That was what we had in the book.
All right, that's right. This is the operating activities. All right, provided for operating activities is 154, okay? Now, notice your investing and financing is the same as it was before. And then the bottom is, all right, your change in the cash equivalents, and restricted cash is $12. That's taking all the inflows and outflows, all right? You add the beginning cash balance, all right, to the change in cash equivalents, and restricted cash. And guess what you get? What? Ending cash. All right. Now, there's one thing I have to tell you here. All right. What are the disclosures for the direct method? All right. Well, first of all, you see the taxes paid, so you don't have to disclose it. All right. You see the interest paid, but if you show the direct method, you must also show a separate schedule of the indirect method. That's the disclosure, all right? If you show the direct method, you have to show the indirect method also, all right? Please keep that in mind. Why? Because I'd like you to. All right, now, is there any questions on that before we look at a few questions? All right, we're gonna look at some questions here. All right, any questions?
Nothing's come in.
All right, let's go to multiple choice. All right, number 27 on page MCQ 1-4. All right, here we go. 27. All right, now, Baylor prepared a statement of cash flow using the direct method. The following amounts were used in the computation of cash flows from operating activities. What amount should Baylor report as cash paid to suppliers? Oh God, you remember what that is? What's our starting point? And the answer is what? What's our starting point? Someone tell me. Don't do the question yet. I don't want cheaters. All right. It's what? Direct method. All right. Cost of goods sold, right? All right. Take the cost of goods sold. Correct. All right, take the cost of goods sold, 1,000,002. All right, now, all right, the next thing, what are we going to use to convert cost of goods sold from accrual to cash? The change in the ending inventory and the ending accounts payable. All right, so therefore, let's look at this. All right, cost of goods sold is 1,000,002. All right, cost of goods sold is 1,000,002 and outflow. All right. The change in inventory. Now, inventory, all right, went up from 200, went from 200 to 150. All right. So the inventory went down by 50,000. Credit inventory, debit fake cash, 50,000. A debit to fake cash is an inflow. Cost of goods sold is an outflow. What are we going to do with that increase? All right. What are we going to do with that decrease in the ending inventory? Let me repeat it. Credit inventory, 50,000. Debit fake cash, that's an inflow, 50,000. We're going to subtract that from the cost of goods sold, was an outflow. All right, now let's look at our accounts payable. Our accounts payable was 300. All right, the ending was 200. It went down. Debit accounts payable, credit fake cash, 100,000. A credit to fake cash, inflow or outflow? Outflow, all right. Cost of goods sold is an outflow. What are we going to do? Add the 100,000 to the 1,000,002. All right. So, thank you. So we can take the 1,000,002, subtract the 50,000 for the change in the inventory. We add the 100,000 to the change in the payable. So therefore, our cash paid to suppliers is $1,250,000. All right. Very good, Mr. Nasser. All right, everyone okay with this?
We did have one quick question about why you must also disclose the indirect method when using the direct method?
Because it's just, why do they have it? First of all, it's part of the pronouncement. I would think that for all disclosure purposes, okay, remember, the method which is most favored is the what? The indirect method, all right? So if you use the direct method, being that the indirect method is most favored over the direct, all right, they want you to show the indirect method too. So therefore, that's really saying, hey, look, guys, just show us the indirect method, not the direct, all right? Because if you show us the direct, you're gonna have to show us the indirect also. The indirect is the most preferred, most used. Okay? All right, are we ready for 29? Multiple choice 29? All right, here we go.
There we are.
It says, company calculated the following: cash received from customers, cash received from sale of equipment, interest paid to the bank on a note, cash paid to employees. All right. What amount should they report as net cash provided by operating activities? All right. Well, first thing, you don't have to do any fake cash method here. All right. Cash received from customers. That's an operating what? Inflow, isn't it? Operating inflow. Cash received from sale of equipment. That would be what? Investing activities. We don't want that one. Interest paid to bank on note. Interest paid is a operating activities, all right? But the principal paid on the note is what? Financing outflow, all right? So interest paid is a operating outflow subtracted from the 25,000. And then we have what? Cash paid to employees, the day-to-day operations. That 8,000 is an outflow. So to summarize, we have 25,000 inflow, 3,000 outflow, 8,000 outflow. The answer is 14,000. It is letter A, letter A. Okay. All right, now here we go. All right, I want to go to, all right, now, by the way, I want to throw a few things at you before I go to any place else. All right, just remember, if you receive dividends in cash, what type of activity is that? Dividends received in cash. All right, and the answer is that's an operating inflow because they use the dividends for the everyday operations if they receive them in cash. But dividends paid is considered a financing outflow. Just remember that. Now, what happens if you bought back treasury stock for cash? If the exam is silent on which method to use, they're not going to be silent. They're not that nasty. No. They have to tell you which method to use, okay? All right? I know there's certain things like, like the dividend received deduction for corporations. I know this is financial accounting, but if they don't tell you what percentage they own of the company, then you assume it's they own less than 20%, okay? But forget that. That has nothing to do with anything. All right, here we go. All right, I buy back treasury stock for cash. I debit treasury stock, credit cash. Where does that go? Remember, all the stockholders' equity sections go into financing. So if I buy back treasury stock, it's financing. Now, if I sell treasury stock for cash, that's a financing inflow, all right? And, all right, if I issue stock for cash, common and preferred, that is what? Financing inflow, okay? Let me see, what else? I think that covers most of them. All right, now, I also have, all right, on page MCQ 32, all right, MCQ 32, which is on, all right, multiple choice 32, which is on page MCQ 1-5.
Yep, we're right there, right on.
Okay, good. All right. Abbott is preparing a statement of cash flow. Abbott's cash disbursements during the period include the following. What should they report as total cash outflows for financing activities? All right. Now, how about the payment of interest on bonds payable? What activity is that? Is that operating, investing, or financing? When you pay the interest on the bond, that's considered operating. Very good. Okay. All right. The next one, payment of dividends to stockholders. What is that? That's financing, isn't it? All right, now a payment to acquire 1,000 shares of Mark's common stock. All right, now you're buying back what? Treasury stock, aren't you? All right, payment to acquire 1,000 shares. Oh, no, I'm sorry, it's very tricky. The company here is Abbott. They're buying 1,000 shares of Mark's common stock. That's what? Investing, right? Very good, thank you. Investing. So I want to know, what's the cash outflows for financing? All right, I would say it's what? What answer do you like? B is correct. It's the 300,000 payment of dividends, okay? All right, and let's look at 33. Let's look at 33. All right, a company is preparing its year-end cash flow statement using the indirect method. During the year, the following transactions occurred. What is the company's increase in cash flows provided by financing activities? Okay, all right, now let's look at this. First of all, we have the following. Dividends paid. That's a financing. And what would you do? Put $300 outflow. All right, now, how about the proceeds from the issuance of common stock? Well, that would be a $250 financing inflow. All right, good. And how about borrowing under a line of credit? You're taking out a loan, right? All right, when you take out a loan, borrowing, that's also a financing inflow. All right, now how about proceeds from the issuance of convertible bonds? It's still financing. All right, so that's a financing inflow. And proceeds from the sale of a building? What activity is that, everyone? Investing. Very good, investing. All right, so what are we going to do here? We're going to take the 300 out, the 250 in, the 200 in, and what do we have here? The 100 in. What do we have here? All right, what's the cash increase in cash flow? And the answer is what? Should be 250 C. Very good. Okay, actually, that's the cash flow, all right? Is there any questions on cash flow?
One question came in, is trading and securities under operating?
Trading, okay. Well, trading securities are where you're going to buy an investment for a short-term period, right? Now, if you buy, all right, first of all, trading securities are not really, I would say, they're readily not convertible to cash. So I would say that would be shown as an investment activity, all right? Because trading securities don't have a maturity date, okay? Am I correct? They don't have a maturity date. Where a CD, certificate of deposit, all right, that is a cash equivalent if the original maturity is 3 months or less. But when you buy stock, a trading security is buying a security, all right? And it generally doesn't have a maturity. That would be an investment in bonds, but no, that is not considered a, what's the question? It's not considered a common stock equivalent. Cash proceeds from settlement of insurance claims are classified as what type of activity? All right, well, if you get an insurance claim, I guess you would be debiting cash, crediting some type of receivable. I would think that would be investing inflow. Okay? All right, does that make sense? All right, now, let's look at, all right, let's go to another. All right, by the way, I'm going to do with you segment reporting. All right, let's go to segment reporting. And that is, trying to remember what, okay, hold on 1 second. All right, we're going to do segment reporting. All right, this is on page, bear with me a second. All right, this is on page 1D4. 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 All right. Now, no one has actually asked me to do any of these, especially this chapter. I don't know why. But, all right, if we go to 1D4, bear with me, I have a book. I have two books here I'm trying to turn. All right, 1D4. Let me see here. I have questions on segment. Where are they? Hold on one second. I got to find the questions. All right, I got segment reporting here. All right, and I have MCQ 1-39. Bear with me a second, please. Just trying to get my notes together. And okay, we're okay. All right, I just want to turn to one page if you wouldn't mind. Let me see. MCQ. Just take 1 second. I have to get to the right page. I want to look for the multiple choice here. Okay, 1 second. All right, I got 91, 92. Okay, 91, 92. No, all right, 1 second, wrong book. I go to the second book. Now, this is, by the way, what I did was to actually, hold on a second, 1D4. I think this is the book I wrote into. No, I didn't. All right, well. All right, I'm going back to the other book. Sorry. Oh, God, take a nap or something. All right. All right, now, let's look at this handout on 1D4. Now, by the way, all right, this is a brand new handout, and it will be in errata, all right? So your 1D4, 1D5, all right, have been changed, okay? All right, now, I know you don't have this, and I've arranged for Sunny, all right, to somehow, all right, put this, I'll find out for you, but, all right, I don't know how we're going to do the errata.
Well, for this particular group, because we have everybody's email addresses from when they registered for the webinar, we can send these couple of pages to them directly, and then we will be adding, I believe the plan is to add the errata pages to our website. So
Right.
For anybody who's not on the webinar, they'll be able to find it that way.
Okay. All right. Please share the PDF 1D4.
Right.
Well,
Robbie,
this is the 1D4.
that's exactly what we were just saying. So we'll
That's
be
what I'm
sending
showing
this
you.
out.
Yeah, it's going to be emailed to you. Okay.
Yes.
All right. Now, segment reporting. It says prepare financial statement, note disclosures for reportable segments. Now, when you look at a segment, let's think about this. All right. We have General Motors, and they have different segments. All right. They make Chevrolets. That's a segment. All right. They also make Cadillacs. That's a segment. What other cars? General Motors, what other cars they make? Cadillac, Chevrolet. Can you think of another one?
Well, they had like GMC trucks.
GMC trucks, all of these. So those are segments of General Motors. Now the question is, do they have to report those segments, all right, in their financial statements? Well, it depends upon whether they're considered reportable segment or not. All right, now let's discuss this. Can you mail us now?
Again, Phil, don't, you can just keep going. I'll be responding.
Okay, and the answer is, I don't think we're that fast. Okay, now, all right, just bear with me on this. All right, in order to determine if it's a reportable segment, and I'll show you multiple choice on this, all right, reportable segments, all right, use a 10% threshold test and an overall 75%. All right, now let's talk about the 10% tests. The 10% test is used to define reportable segments if, one, all right, if a reportable segment has 10% or more of the combined revenue of the companies, now that includes sales to outsiders and inter-segment sales, or 10% of the greater the absolute amount of its combined profit or loss, okay? I'll show you that, or 10% or more of the combined assets. Now, the 75% test is to ensure there's enough segments being reported. Segments reported must cover 75% or more of the consolidated sales, all right? So if a segment does not actually, you have to report enough segments so that they equal 75% or more of the consolidated sales. All right, and sales are a component of revenues. But it says in the pronouncement, 10 reportable segments is typically enough. Any more than 10 may get confusing and not recommended. All right, now let's take this fact pattern below. And then I'll show you multiple choice. Can we move this up? All right, now we have the following. All right, below is a simple fact pattern, an application of 10% rules and the 75% rule. All right, in this case, all right, all segments are potentially reportable, and for this reason, the 75% test is met. All right, now let's look at segment A, B, C, D. They give you the segment revenue, the segment profit or loss, and the segment assets, okay? All right, now what we do is we take segment A. Segment A is $39 of the total revenue of $628, all right? If the segment revenue is more than 10% of the total revenue of the entire, all segments, then it's a reportable segment. So if we take 39 divided by 628, from a revenue percentage standpoint, it's only 6.2%. How did I get that? 39 divided by 628, 6.2%. Based on the revenue percentage, it's not a reportable segment. All right, now we look at segment B. Segment B's revenue is $204. All right, the total segment revenue of all segments is $628. 204 divided by 628 gives you 32.5%. All right, based on that, it's a reportable segment. But if you look at CD, all right, taking C 60 over 628, that is only 9.6. Got to be what? 10% or more. And then we got D is not based on the 10% or more. All right, and therefore, all right, it's only 8%. All right, so therefore, based on the segment revenue test, which one are reportable segments based on the revenue percentage? All right, B, all right, and E. But remember, they just have to meet one of these tests, the 10% revenue, the 10% of segment profit or loss, and the segment assets. Just one in the reportable segment. All right, so based on just the revenue, B and E are reportable segments. Now let's go to the profit and loss. Now all of these segments have a profit. All right, easy. 17, 6, 18, 20, 44. That's segment A, B, C, and D. Once again, we do the allocation. 17 over 105 is 16.2. 6 over 105 is 5.7. All right, and we continue on with that. So based on the profit percentage, all right, segment A is 16.2%, all right? Segment B is 5.7. Segment C is 17.1, 19, and 41. So based on the more than 10% test for the profit, which are reportable segments? A, B is not, C is, D, and E. All right, and you do the same thing with the assets. Now just remember, if you look at segment A, based on percentage revenue, it's not more than 10% of the total revenue of all the segments, but because of the profit test, all right, it's more than 10% of the profit, A will be a reportable segment because it just has to meet one of these more than 10% revenue, profit, or assets, okay? All right, now, B looks like it's a reportable segment because of the revenue and the asset percentage. Just have to meet one. C is a reportable segment because of the percentage of profit, 17.1, and the asset, 14.8. D is also a reportable segment because it meets the profit test and the asset percentage test. They only have to meet one of these. And then E, all right, is definitely a reportable segment because it's more than 10% for the revenue, more than 10% for the profit, and more than 10% for the asset percentage. So it says, note that in each of the above cases, the segments equal or exceed 10% of overall revenues, okay? Profit, loss, or assets, all right? For example, segment B is $204, all right, divided by 628, which equals 32.5. that would be a reportable segment. You only have to meet one of these tests, okay? All right, now let's go to page 1D5. This will all make sense in a second, okay? 1D5, okay? Now, can we make this smaller so we can show the top?
No, this is the top. This, because it's a separate page.
Okay, all right, now, if you look at 1D5, that's what you look, well, that's a little small. No, that's all right. 1D5. All right, now 1D5. This just shows you, all right, how under the revenue, profit loss, asset test, reportable segment, all right, notice segment A does not meet, it says no, it doesn't meet the more than 10%. But for the profit and the assets, it does. So it is a reportable segment. Only has to meet one. B is yes for the revenue, no for the profit, yes for the revenue. It's still a reportable segment. These are all reportable segments. Now, let's change this and make it a little more complicated. A slight modification to the above tests are the same fact pattern, but we have two operating loss measures. All right. Now, let's see what we have here. Segment A, all right, is all profitable in the revenue, profit, and assets. All right. But let's look at segment B. They have revenue of 204, but they have a negative loss of 6. Segment assets 107. And then if you look at C, it has a profit of 18. D has a loss of 20. And E has a profit of 44. All right, now this is what you do. All right, we take the same percentages again. The revenue is $39 over 628, 6.2%. 204 over 628, 32.5, and so forth and so on. Now, this is the next thing. All right, on the profit and loss, it says on the bottom, note, the absolute amount of profits are segments A, C, and E. So if you look at segments A, it has a profit of 17. All right, C is 18, and E is 44. All right, so if you take the profits of 17, 18, and 44, they equal 79. The segments which have absolute losses are segments what? B, 6, D, 20. Okay, all right, which total 26. A reportable segment is where you take 10% or more of the greater of the segments with a combined profit, which is $79, or those segments with the combined losses, which equals 26. Now, we're going to take 10% of the 79, which equals $8. And then we're going to take 10% of the 26, ignoring the fact that it's a negative. All right. So in order to be a reportable segment under the profit/loss percentage, all right, it's going to be the greater of 10% of the profit amounts, 79, which is 8, or 10% of the loss segments, all right, which is 2.6. Ignore whether the numbers are positive or negative. The greater is $8, right? All right, we're going to take those segments which have what? Greater than $8 or more, and they're reportable segments under the profit/loss percentage. All right, so therefore, what is that saying? The segments of profit or losses that exceed 8 are separately reportable segments. For example, segments A, all right, they have 17, that's more than 8. B is not reportable, all right. C is 18, it's more than 8. A minus 20, it's still more than 8. Ignore the minus, and 44 is more than 8. So therefore, please note, under that test, the segments A, C, and D, and E are reportable segments. Segment B is not, because the $6 does not exceed. But remember, all you have to meet is one of these tests, and your reportable segment. All right. Now, last point here. Often to determine profit/loss of a segment, some costs are traceable and others are common costs. All right. Now, with that in mind, is Brian saying, what would they ask me on the exam? All right. Let's go to multiple choice, 91 and 92 on MCQ 1-16. All right. I'm going to show you what they will ask you. All right. MCQ 1-16. All right. There's 91. All right. Now let's read this. Eller Company discloses supplemental industry segment information. The following data is available for 20X5. All right. Segment R, sales, traceable cost, 240,000. How much do you allocate to R? Question mark. All right. They give you the same thing for S and T, the sales and the traceable costs. Now remember, the traceable costs are direct reduction of the sales because you can trace them to which segment they are. But the costs that are allocable, all right, have to be prorated. All right. So what are we going to do here? It says, all right, the costs are appropriately allocated based on the ratio of a segment's income before allocable costs to total income before allocable costs. What is the operating profit for segment R? All right. Now let's take segment R. All right. Write this down. All right, please. You have sales of 300,000. All right. Now remember, you already given me the answer? Okay. All right. We'll see if it's, all right, here we go. All right. Here we go. All right. We have 300,000 minus 240. All right. So we have an operating income of 60,000. Now, notice it says, all right, that the allocable costs are allocated based on what? And the answer is a ratio. All right. Now, how do we get this? All right. We have operating income. All right. How do we do this? Of $60,000. All right. Now, the allocable costs are based on the ratio of a segment's income. All right. Let me go over this. Segment R, the income is 300 minus 240, 60,000. All right. To the total income before allocable costs, which is 300,000. All right. Now, how much are the allocable costs there? The allocable costs are 120,000. All right. So therefore, based on the operating income of R divided by its total income of 300,000, all right, 60,000 over 300,000 times 120, all right, gives you allocable costs of 24,000. All right. So therefore, we have sales of 300 minus traceable cost of 240, allocable cost of 24,000 off. Your operating profit is 36,000. Answer C. Does everyone see that? All right. All right, let's try one more here. All right, let's go to number 90. Number 90. Oh, wait. All right, who does not see it? All right, let me repeat this one more time. Okay, there it goes. One more time. All right, we have Eller Company. They have supplemental industry segment information. The following data is available for 20X5. Now remember, the traceable costs are directly a reduction of that segment because they're traceable to that segment. But the allocable costs have to be allocated based on some ratio. All right, now let's see what it says here. Costs are appropriately allocated, the allocable costs are allocated based on the ratio of the segment's income before allocable costs divided by the total income before allocable costs. All right. So let's see what we have here. The sales on segment R, that's what they're asking here. All right, is $300,000. That's the revenue. All right. Now we're going to subtract the traceable costs of 240, which gives us operating income before allocable costs of $60,000. All right, now, how do we prorate the 120,000 allocable costs? All right, we take the operating income before allocable costs for segment R of 60,000. All right, and we divide that by the total income before allocable costs. The total income of R is the sales of 300,000. So we take the 60,000 operating income, all right, before allocable costs of R, 60, and divided by R's total revenue of 300,000. All right, so the ratio is 60 over 300, 1/5. All right, we multiply that by the allocable cost of 120. So the allocable cost to segment R will be $24,000. Now, based on that, let's get the operating profit. The sales are 300,000. All right, we subtract the traceable cost of 240, and then we're going to subtract the cost we allocated to segment R of 24,000. 300 minus 240 minus 24 gives us an operating profit of $36,000. Answer C. Do you see it now? Got it. Okay, good. You know, the point is this. If you didn't get it immediately, all right, don't worry about it. As long as you get it. Can you solve the same for S and T? I guess I could. All right, I'll make you happy. I haven't done it, but all right. All right, let's take S. Okay, can I do S with you? All right, let's do S. Let me get a pen. All right, so S. S has sales of $400,000. You're welcome, Cheryl. 400,000. All right, subtract the traceable cost of 220. So the operating profit is 180,000. All right, we divide that by the total income of S, which is 400,000, and we multiply that by the allocable cost of 120,000. So everyone see that? All right, here's your ratio. All right, you have the, first of all, we take our sales, all right, which is 400,000, subtract the traceable costs, which gives us the operating profit before allocable cost of 180,000. We divide that by the total sales of S, all right, and that's 180 over 400. 180 divided by 400, all right, that's 45%. So 45% times 120,000 is 54,000. So, all right, the allocable cost of 54,000. So now we have 400,000 minus 220 is 180. 180 minus 54. Okay, equals 126. Very good.
Yeah, people are getting that. That's great.
All right, good. You know. All right, now let's look. Oh, here's one. This is a bear. Okay. All right. Let's look at 90. Let's go to 90. All right. All right. So 90. 90 says the following. All right. 90. Planes and gauges. Now, by the way, they could ask you a question. We don't have one here, but they could ask you if it's a reportable segment. Okay. All right. I showed you 3 tests. Very straightforward. All right. But let's look at number 90. Planes and gauges in 3 types of businesses, each of which is considered to be a significant industry segment. All right. Company sales aggregated $1.8 million. That's the entire company in 20X9, of which segment number 3 contributed 60%. Traceable cost was $600,000 for segment 3 out of a total of $1,200,000 for the company as a whole. In addition, $350,000 of common costs are allocated based on the ratio of the segment's income before common costs, the total income before common costs. Looks like the allocation is the same. All right, now this is the way you're going to set it up, okay? On the top, here's your head, here's the captions, all right? Put one column, it's going to say entire company, all right? To the right, put segment 3, and then, all right, the third column is other segments. All right, so we have 3 columns, the entire company, segment 3, and other segments, okay? All right, now the first thing we're gonna put, all right, first item, go to the left, all right? List down sales. The sales of the entire company are $1.8 million. All right. And it says here they want segment number 3, right? All right. Segment number 3 contributed 60%, right? All right. So what we're going to do is we're going to take 60% of $1.8 million. All right. What is 60% of $1.8 million? All right. Comes out to $1,080,000. Do you have that? So under segment 3, put sales $1.08 million. Now, if the entire company has $1.8 million, segment 3 has $1.08 million, then all other segments are what? $720. Very good. All right. Now, let's take our traceable costs. All right. The entire company has traceable costs of, all right, $1,200,000. All right. Now, what we're going to do is we're going to find that the traceable costs for segment number 3 were $600,000. All right. So the total traceable cost is $1.2 million. All right. So we'll put $1.2 million on the entire company as a subtraction from the sales. All right. Segment 3. All right. We're going to take $600,000. That's what they tell us here. All right. $600,000 is traceable cost for segment 3. And then if the total traceable cost for the entire company is $1.2 million and $600,000 is segment 3, the other segments are $600,000. All right. So let's see what we have here. All right. They're asking for what's the operating profit for segment 3. Okay. All right. So far we have $1.080 million sales, less traceable costs of $600,000. All right. For operating income of $480,000. Okay. Now, what are we going to do? We're going to take the $480,000, all right, and divide by, let me see here. What does it say? We're going to take $480,000 and we're going to take the, why am I doing this? Something is wrong with what I'm doing. And it says here that I get the answer, but I don't know why now. That's crazy. All right. We have, what should the report is operating profit for segment number 3 in 20x9? All right. So the way it's done is you take the common costs. All right. The common costs are, addition, 350 common costs allocated based on a ratio. All right. So the 350,000 is the common cost, right? All right. And we're going to multiply that by what? I got 480 over 1080. You know what? I'm going to have to cheat and look at the answer. I don't know why I got it. All right. Bear with me. I apologize. This is MCQ 1-39. All right. Hold on a second. If someone comes up with the answer, I wish. Okay. Let me see here. All right. They do this. I don't know. I'm missing something. It's too obvious. All right. Now, they have the $1.8 million. All right. Sales. All right. Now, income is 480 before. All right. Now, what they do is they take 480 over 600. All right. Traceable costs were 600 for segment out of a total one. Okay. In addition, allocated based on the ratio of segment's income to the total income before common costs. All right. Is the answer A? Did you get A? All right. They show, I don't know if this is correct in the book now. They show in the book, they show that since segment 3's income before common costs is 80%, they show 480,000 over 600,000. Is that a correct allocation? Anybody? It is. All right. I'm not sure what I'm missing. I've 480 over 600. All right. I can't get an answer from you because I'll tell you what, I don't know why what should be the operating profit? All right. 80 divided by 600 equals 280, right? I got 326. I think if you look at it, all right, the income is 480 over 1080. I don't know where they got. All right. Ladies and gentlemen, I think I have the wrong answer here. Let me see what he did. All right. Operating profit. Oh, I see. Okay, I made a mistake here. All right. Now I see what he did. All right. Sales, segment 3 is $1,080,000. All right. Traceable cost 600. Operating is 480. Okay. All right. So you're gonna take. I still have that. I don't know what I have. Answer A. Total income is 1,000,008 minus 600,000. All right. What's your ratio then, please? It would be 600. You know what? 600, 80%. Well, that's okay. 480 over 600. I'm missing something here. Operating. All right. You know what? I will tell you next time. Bear with me a second. I just want to make sure that I did this right. Okay. I apologize. I wrote it down, but I'm not sure why that's the answer. All right. Anyway. All right. You can please don't remember me by this one question. Okay. All right. All right. So I'll finish this one. I promise. For the income before common costs. All right. I'm sure most of you are looking at this as I speak, and that's great. Okay. Now, I want to skip over the ratios calculated as operating costs divided by total operating costs. Is that what it says? The ratio is segment income before common costs, the total income. Okay, based on the ratio of segment income to total income before common costs. Okay. All right. Oh, I see your point. Okay. That's correct. I apologize. No, you're all right. Okay. So the correct answer is what then? Someone?
We're getting a lot of people saying A.
Okay, that's correct. I'm sorry, I didn't see that. You know, after a while you look at something, all right? I can look, that's why sometimes you look at something, you can't get the answer, you can do one of two things. Walk away for a few seconds and then come back to it. All right? Now, without further ado, let's move on here. All right, let's go to page 2E2. 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 All right, now, I want to go over investments, all right? This is updated, all right, for 2016-01, all right? And let's talk about the different types of investments because this has changed, okay? All right, now, we have investments classified by investments in debt securities, bonds, okay? All right, and it makes no difference what percentage you own, all right? Because you have 3 classifications. Now remember, these are investments in bonds. Now, if you hold them for a long term, they're called held to maturity. All right. Now, held to maturity are shown at amortized cost. Okay. Amortized cost. Okay. We're on, let's go back. I appreciate everyone working this out. All right. Let's go to this page, if you would. All right. All right. Now, what's the page again, Carrie?
We're on page 2E-2.
2E-2. All right. Once again, investment in debt securities. All right. Now, no matter what percentage you own, there's 3 classifications. Held to maturity. All right. Now, if you have investments in held to maturity, which means you're going to hold them for what? Till maturity. All right. You show them on your balance sheet at amortized cost. Now, amortized cost is the carrying value. So you show the investment at cost less, all right, or plus unamortized discount, unamortized premium, all right? Now, if you have investment in debt securities that you hold for a short term, all right, you're going to show them at fair value. For example, let's assume your original cost was $100,000 when you purchased them. At the end of the year, they're $40,000. So they've gone about down in value by $60,000 because you have to show them at fair value. All right. Now, if you have a loss, what entry do you make on the books? Well, for a trading security, you'll debit unrealized loss. All right. And you'll credit allowance, all right, or valuation allowance for trading securities. Okay. All right, now, the unrealized loss on trading securities. Where do you show that? Where do you show that? What's the questions I'm getting here?
I don't think that there has been
Okay, all right.
so far.
Let me start again. You know what happens when that comes up? It blocks the screen. All right, now, can you make this a little bit, let's make this bigger if we can.
You want just the,
All right, let's leave it the way it is. Okay, once again, all right?
again,
Investments in held to maturity are amortized cost. All right, now, let's take investment in a trading debt security. All right, I buy an investment in a trading security of 100,000. That's the cost. Now, at the end of the first year, all right, the fair market value is $30,000. It's declined by $70,000. All right, now when there's a decline, what entry do you make on the books? You debit, if it goes from 100,000 to 30,000, you debit unrealized loss, and you credit valuation allowance account, which is a contra account to the investment. Now, where do you show the unrealized loss for trading security? You show it in the income statement. All right, now, when it's held for a long-term purpose, now, available for sale is long-term, which means that you're not holding it for a short term, you're not holding it to maturity, you're just holding it for a long term. So what you would do is you must carry the investment at fair value, all right? So if I paid $100,000 for an available for sale, and at the end of the first year, the market value is 30,000, all right? I've had a decline, a holding loss. Now, what entry would I make for available for sale? I'll debit unrealized loss, and I'll credit a valuation allowance account, all right, which is a contra account to the investment. Now, the question is this: if you show an unrealized loss of 70,000, all right, where are you showing unrealized loss for actually available for sale? And the answer is you show it in other comprehensive income. Good. All right, now let's go to the next caption here. All right, now these are investments in equity securities. That is correct. All right, now investments in equity securities. If you own 0 to 50%, there is a presumption you can exercise significant influence. Therefore, you must use the equity method, okay? No, we missed one. I'm sorry, Carrie. All right, I'm sorry.
Missed what?
No, it's always, all right, let's go back here. We have an investment bonds. I went through that. Held to maturity, trading, or available for sale. Now we have investment in equity securities. You break those down between owning 0 to 20%, all right, and 20% to 50%. All right, now, if you own 19% interest in equity securities, all right, how do you carry it on your balance sheet? Now, if you have a readily determinable fair value, all right, you show it at fair market value. So if I pay $100,000 for an investment in an equity security in which I own 19%, all right, if it has a readily marketable value, all right, at the end of the year, because it's traded on National Stock Exchange, let's assume it's 70,000. At the end of the year, I had a reduction of 30,000 by holding it. It's a holding loss. Now, how do I show this? Well, I'm going to debit an unrealized loss, 30,000, and credit a valuation allowance account for, I'm sorry, I'm going to debit, everything's falling apart here. All right. If I have a reduction in a less than 20% investment in equity security, all right, what I'm going to do is, all right, if I have a loss, a decline of 70,000, I'm debiting an unrealized loss of 70,000 and credit a valuation allowance account 70,000. Now, remember, if you has a readily marketable value, then you're going to record an unrealized loss, or if it goes up, you'll record an unrealized gain. But if you have an investment in equity security of which you own less than 20%, and it doesn't have a readily determinable market value, why? it's an investment in a private company, not a publicly held company. Private companies don't have a readily determinable market value. So therefore, if it doesn't have a readily determinable market value, you show it at its cost, historical cost. Now, also, you must test that for impairment. If it doesn't have a readily determinable market value, all right, you must test it for impairment. Now, what does impairment mean? Impairment means that generally, all right, the fair market value will be less than the carrying value, all right? And if that's the case, all right, then you have to record a loss impairment. But if it's not impaired with no readily determinable market value, all right, you're going to show it at historical cost. All right, now, if you own 20% to 50%, there is a presumption that you can exercise significant influence, all right, over the affairs of the company. All right, now, under the equity method, this is what you do. I own 20% interest in B company. I'm A company. All right, I paid $100,000 for the investment, and B company has a net income of $20,000, and also B company paid out dividends of $10,000. All right, now what's the deal here? All right, what entries do I make for this on the books? Well, for the actual acquisition of the investment, $100,000. I'll debit investment for $100,000. Credit cash, $100,000. Now, under the equity method, if you own 20% or more, all right, you got to pick up a proportionate share of the earnings of the company you invested in. All right, so if A invested in B and B has net income of 20,000, all right, what entry, all right, will A make on their books? They will debit what? Investment for 20% of the net income of 20,000. 20,000 is the net income of B. A owns 20%. 20% of 20,000 is $4,000. And the credit will be to equity and earnings, which is an income statement account of $4,000. Now, B paid out dividends of $10,000. A owns 20% of that. So A is going to do what? They're going to take 20% of B's dividends that they paid out to everybody. 20% of 10,000 is 2,000. All right. What they'll do is debit cash for 20% of 10,000, which is 2,000, and they'll credit the investment account. Now, I want you to know this. Even though you own more than 50% interest in another company, you are a parent-subsidiary relationship, and you must consolidate as long as the relationship is one of a permanent nature. Now, please keep this in mind. Even though you own more than 50%, you will still carry your investment in that other company, the investment in the subsidiary, at equity. The equity method will be used. Please remember that. All right. So the equity method is used for, all right, anywhere from more than 20%, or 20% or more, up to 100% interest. All right. That is the equity method. All right. The equity method. All right. Now, let's go back and have a quick review of what we discussed here. All right. We started off with the indirect method of cash flow. All right. What do we start off with the indirect method? We only have 2 minutes. All right. All right. On the indirect method, you start off with what? Net income, right? And, all right, what you're going to do is you're going to add back non-cash expenses like depreciation expense, bad debt expense, amortization of patents, etc. All right. Also, you're going to also add losses back. Someone asked me that. Why is it that a loss is added back to the operating activities? All right. Let me show you why. Let's assume I sold a piece of equipment. All right. That cost me $20,000. I haven't depreciated it. All right, you're supposed to. All right, I sold a piece of equipment that cost me $20,000 for $30,000. So I'll debit cash 30,000, credit equipment 20, and credit gain for $10,000. All right, because someone asked me, why is a gain subtracted in the operating activities from the income? Why is it considered non-cash income? And let me explain to you why. If you sell a piece of equipment for 30,000, all right, the 30,000 cash you debited goes as an inflow to investing activities. Now, in the net income is the gain of $10,000. Now, isn't it true that the sale of the equipment for 30,000 includes the gain of 10 because you're selling equipment for 20 plus 10 gain. So the gain is in the investing activities because you're increasing your inflow by 30,000. The gain is also in the net income. So if you don't subtract the gain from the net income of 10,000, you're including the gain twice in the operating activities section and also in the investing activities. Does that make sense to the person who asked me that? All right. Let's take a loss situation. All right. Let's assume I sell it for $5,000 in cash. Debit cash 5,000, credit equipment 20, debit loss for 15,000. Now, how are you going to treat that on the statement of cash flow? The $5,000 cash that you debited for the sale of the equipment goes into the investing activities as an inflow of 5,000. All right. The loss of 15,000 is already in the income. It reduces net income. So if you think about it, you're giving away equipment for 20. All right. You're getting 5,000. All right. And there's a loss of 15. If you do not add back that loss to net income, you're including the loss in the investing activities section as well as the operating activities. That's why you add it back. You don't want to double count it. I hope that the person who asked me that question, are they still with me? Anybody?
I'm not seeing anything come up right now.
Okay. All right. Now, I do apologize for not being able to see that thing. I'll go back and look at it. All right. All right. Do you see? Oh, does that make sense? Thank you. All right. Great. All right. But you know what? You don't have to think about that. Just add back losses, subtract gains from net income. And remember, the other things that are adjustments to net income under the indirect method are, all right, changes in current assets and current liabilities applying the fake cash method. All right. And I have a question for those who are still with us. All right. All right. What is the two disclosures you have to show if you use the indirect method? All right. Write them down. What are the two disclosures if you use the indirect method? All right. Let's get a few people answering. Interest and taxes is correct. All right. Now, if you use the direct method, exactly. If you use the direct method, everyone, all right, what is the disclosure you have to show? The indirect method. Very good. Okay. All right. Now, I would say of what we went over, all right, the cash flow was the most important thing. Okay. Because there's always a large cash flow on the exam. Not always, but you'll have it in multiple choice as well. All right. Now, these are the areas very quickly. Make sure for large problems, you know business combinations. Write this down, please. All right. The large task-based simulations are business combinations, statement of cash flow. Also, all right, they may give you this. All right. I think I've mentioned this to you. They'll give you, we have to correct certain statements. For example, they will put items that should be in other comprehensive income in the income statement. All right. You follow that? They're going to put items in the income statement which are really comprehensive income, and you have to take them out. They'll ask you what you have to do to adjust them. Also, make sure you know how to take financial statements, income statements, and go from cash to accrual. Cash to accrual. The other one is a bank reconciliation. Believe it or not, bank reconciliations have been task-based simulations. And then another one they've given, which is, it's actually in the book, is they'll give you a general ledger for accounts receivable. And then they'll show you the subsidiary ledgers, all right, for accounts receivable. That's the accounts receivable of every person that owes you money. And if you add up all the subsidiary ledgers, it should equal the general ledger account, the control account, but it doesn't. And what you have to do is read the facts and see why they're different, okay? They may ask you to correct that. And without further ado, that's enough. All right?
Well, actually, I think that this is a really great segue to what I'm about to enter into our chat box, and that is the link to our webinars page. So obviously, the webinars that we've been doing on these Sundays have not been available as recordings, but we do have a significant library of recordings that we have done in the past several months, many of which cover these topics, the ones that Phil has just gone over. So since the AICPA has not released new blueprints, since ones that went into effect as of July of 2019, all of the webinar recordings that we have available on that webinars page and that link are all still current. So please, at your convenience, go to that page, take a look, find the topics that are of interest to you, and watch those webinars. And that way you'll be able to fully verse yourself, in addition, obviously, to using the course materials, but all of these topics that Phil has just gone over.
If I may share one thing with everyone, okay? This is a key thing, all right? You have to study as much as you can, okay? And you want to study what's in the blueprints, all right? But remember, you're not going to remember everything. The exam is curved. And let me tell you how it is curved, all right? They get all the papers, okay? And what they do is, all right, they look for a cut score. It's like a golf tournament. You know, in a golf tournament, after 2 or 3 rounds, if you don't have a certain par value, they cut you, all right? So they take everyone, and they're looking for a certain cut score. It could be 56, all right? Then they'll take the people who hit that cut score, and they'll decide, all right, who has the highest cut score. And they'll also decide what percentage of those people they want to pass. And you know what's been interesting, all right? Someone had a task-based simulation, and they got most of it wrong, and they said they were comparable on the diagnostic report. So every exam is different. I tell you, on a task-based simulation, try to do 60% of the responses correct. But you know what? It could be only 40% that's enough to get full credit. It's dependent upon how everyone else does, all right? It was sort of like my wife took an anatomy course in college, all right? And the professor made the exams very, very difficult. I remember this. And she would score a 50, all right? And you'd say, that's terrible, 50? But do you know her average of 52 at the end was a B in the course, all right? And that's the way they did it. Instead of making the exam really easy so everyone gets high grades, they make it difficult so the grades are lower. And based on those low grades, they can determine which will become passing. So when you get a 75, 76, it's not really necessarily a 75, 76, okay? But study hard. Do it. You know, I know during this virus situation, you're tired, you're fed up of staying home. I understand that. I think I feel the same way. Carrie feels the same way. But you got to remember, why are you doing this? Everyone I talk to tells me the same. I'm doing this because either I want to get a better job, make more money, all right? Or I can't stand the job I'm in. It's so bad, all right? But right now, without the CPA, I can't go out there and compete with other jobs. And I'll tell you one thing that came out of this virus, all right? We have become a necessity, believe it or not, just like doctors. And why is that? because all these loans, the care loans, everything, there are CPAs that are actually learning how to fill out the paperwork, which is so darn confusing. So we're becoming a necessity. And please do this. I am doing a podcast with a gentleman, all right? And he's going to show you how you're going to make money as a CPA if you go into your own practice is this. You have to come up with a niche, okay? This is what it means. His wife is a dentist, okay? She specializes in prosthodontics, bridge crown work, all right? Now, 85% of his clients are dentists. He's a specialist. He knows dentistry. He knows he knows dentists are the worst investors in the world. That's true with doctors too, all right? They're very poor in business. He is an investment advisor, all right? He tells them what to do. And he learned this by dealing with different types of dentists and what the problems are. He can charge $300 an hour, all right, versus someone who just does tax returns and, maybe gets $75, $100. You have to get a niche, an area that you are very well versed in, all right? And that will make you a difference of making a wealthier CPA versus someone who just makes a living, all right? And that will be a podcast, all right? Please watch. It's going to be called How to Get a Niche in Public Accounting, all right? I'm going to record it this Tuesday, all right? Check my podcast, CPA Review and More, all right? And look, by the way, there's interesting topics on there, okay? All right, enough of my podcast. I just want to wish you this, all right? I want to wish you all, for those who apply, a happy Mother's Day next weekend. And we will tell you when this will be up again next week, all right? One way or the other, you will have a class hopefully next week. I promise you, all right? And for those who are going into the exam, best of luck. Remember, you're going to have 20 multiple choice in governmental and not-for-profit, 20, all right? I would say 16 are governmental, the remaining are not-for-profit, all right? Always expect 20 multiple choice on governmental and not-for-profit, okay? All right, that is it. Carrie wants to go home, although she is home, all right? And I'm home. So anyway, good luck on these.